Good morning, everyone. Welcome to the class on investment management. Students, I have completed technical analysis. We have completed the basic understanding of what is technical analysis, and then we try to understood the term like support and resistance, and then we have learned charts. So while working on charts, we have talked about candlestick diagram. We try to understood different types of moving averages like simple moving averages and exponential moving averages. In indicator, I have done RSI for you, relative strength index. Okay, so there is one more indicator is there called MFI, money flow index. For that, I'll make a separate video and I'll post in the group. So if you people are interested, you can watch that video to understand what is MFI, money flow index. But as per what I saw in VTU syllabus, like they are never asked the problems related to money flow index. So again, that is little bit complicated than RSI. RSI was very simple. So probably that reason they ask in exam. MFI would be little bit of calculative. I maybe for that reason they have not asked. So I try to put there's a separate video on MFI. So if you get time, you can watch that video to understand how MFI, money flow index, how that is different from RSI, relative strength index. So Excel part you can do that. You can do that. Otherwise, if I give you basic understanding of a money flow index, what is money flow index basically do? So in money flow index, we consider different variables. Either it is opening price, or it is closing price, or it is highest price, and then we also give preference to the volume also. Talking about RSI, when we are discussing RSI, in RSI we only considered one variable, that was the closing price of stock. So then altogether, if you see the implication, so it's not like the closing price of stock which gonna give us the better picture about what is gonna happen with the stock next time. So more than the closing price, it's all about the whole day activity which has happened with respect to the stock, and then the volume again is very important parameter. So in that regard, we should give more preference to MFI over the RSI. Altogether, either we talk about MFI and RSI, both are basically oscillator, which gives us a value between 0 to 100, and above 70 in above 70 in RSI is considered as a overbought region. So and below 30 considered as oversold region. Similarly, in MFI also, instead of 30 and 70, in MFI, the basic number what we consider is 20 and 80. So 20 is considered, when we see 20 is considered as basically oversold region, while 80 is considered as overbought region. So altogether, RSI and MFI look similar in the term of number, but MFI consider more variables than RSI. So in that context, I we can say that MFI would be the better indicator than RSI. So in MFI, first we calculate something called typical price. So you can see here typical price. Typical price is the average of highest plus lowest plus closing. It is the average of highest, lowest, and closing. And then we multiply this typical price with the volume, which we called as a money flow. So we multiply the typical price with volume, which we call that as a money flow. And then we divide this money flow as a positive money flow or negative money flow, depending upon if the today typical price is more than yesterday typical price or not. So if the today typical price is greater than yesterday typical price, then we call the positive money flow. While if the today typical price is lesser than yesterday typical price, considered that as a negative money flow. And then we calculate the money ratio, which is nothing but it is the average of positive money flow divided by negative money flow, and then money flow index is being calculated. So in when we are using RSI, when we are using uh, RSI, in RSI we only took one factor into consideration. When we are talking about RSI, we took only one factor into consideration. That was the closing price of the stock. So we got the closing price of stock. We got the closing price of the stock, and then what we did, we simply find the daily gain or loss by simply finding the value of today closing price minus yesterday closing price. If today closing price is more than the yesterday closing price, the that value we put then that value we put under gain. Closing price is less than the yesterday closing price, then that value we put under loss. So that was a simple calculation we did when we are doing then when we are doing the RSI. So RSI, we simply found the today closing price minus yesterday closing price, and if that is more, then we put that under gain, and then if that is less, then we put that under loss. Once we found the gain and loss, then in RSI what we did, we simply found the average gain. We simply find the average gain. So average gain, for doing the average gain, we took an average of 14 days. Then we simply found the average loss. So average loss is again nothing but it was the average of the 14-day loss value. Once we got the average gain and average loss, then we found RS, relative strength, which was nothing but it was the average gain by average loss. That was the relative strength. So once we found the RS, then we found the RSI. RSI is basically 100 minus 100 divided by 1 plus RS, relative strength. So, like as per what I saw in the pattern, that like 1 year the VTU asked question on exponential moving average. The other year it asked on RSI. So for you senior, they have asked question on RSI. If you see 1 minute, if you see the paper for your senior, so the last year paper, if you observe, so in last year this 2000, so for you people it would do 2001. So for your senior, they have asked question on exponential moving average. So for you people, according to me, the problem will come on RSI. Already I have made 2 videos on RSI. So if you get time, whenever you can watch those 2 videos. In one video, I just simply solve the problem of VTU. In another video, I solve the same problem in MS Excel. So if you get time, you can watch this. So this is 2000, January 2000 question paper. So in this, you can see the problem coming of EMA, exponential moving average. So according to me, it's time for you people, the problem will come on RSI. So when we talk about RSI, in RSI, we simply considered one factor. But when we talk about MFI, why MFI is better than RSI? So in money flow index, what we do first, we calculate something called typical price. So typical price is nothing but it is the average of open plus high plus low. So it is average of open plus high plus low. So this is typical price. And then we calculate the value. What is the value? Multiply the typical price with volume. We multiply the typical price with volume. So when we multiplied price with volume, we call that as a money flow. Okay, and then once we get this money flow, we divide this money flow into two head. Either it can be positive money flow, either it can be positive money flow, or it can be negative money flow, or either it can be negative money flow. Positive money flow you will get if the today typical price, if the today typical price, if that is more than the yesterday typical price. So if today typical price is more than yesterday typical price, then we call this as a positive money flow. While if today typical price, if today typical price, if that is less than the yesterday typical price, if that was less than the yesterday typical price, then we call that as a negative money flow. So once we got the positive and negative money flow, we took the average 14-day average for that. So that we called as a money strength or money ratio, and then we found MFI, money flow index, which is again the same formula: 100 minus 100 divided by 1 plus money flow index. So money flow strength, whatever you can say. So that is altogether that is altogether how the flow index is being calculated. So you can see this in Excel. So this is highest, lowest. So then we found the typical price. Okay, this is high plus low plus close. Okay, this is high plus low plus close. Okay, so this is high plus low plus close, not the open. So this is high plus low plus close. This is high plus low plus close. The average of high plus low plus close. So this is the typical price. We just simply took the average of this. You can see that. So then we multiplied the typical price with volume that we called as a raw money flow. So we multiplied it by volume. We call this as a raw money flow, and then we consider that as a positive money flow or a negative money flow, depending upon the typical price. If the today typical price is more than yesterday typical price, then it was positive money flow. While if the today typical price is less than yesterday typical price, then it is negative money flow. So once we get the positive and negative money flow, we found the either the average or sum of them. Okay, so 14-day average you can find for them. And then we divided them. The 14-day positive money flow divided by 14-day negative money flow average. We call that as a money ratio. And then we use the value formula, same formula: 100 minus 100 divided by 1 plus money ratio. And that we called as a money flow, MFI. So again, this is again oscillator, which will give you value between 0 to 100. This is about MFI. So there are more indicators are there, like a stochastic oscillator, William dot percentage R. Okay, then you have ROC, rate of change, on balance volume. So parabolic SAR, lot of tools are there in technical analysis. If you get time, you can read about them. So whenever if you get time about to know more about technical analysis, you can go to moneycontrol.com. So in money control, if you go for any stock, you go for any stock in money flow, you go to this website, money flow index. You can see that if you want to see the name of the technical analysis tool, what you need to follow, these are the tools: accumulation, distribution, a average directional index, ATR, average two range, commodity channel index, check-in money flow, slow or stochastic, fast stochastic, MACD, momentum, MFI, which I just now discussed, OMV, on balance volume, rate of change, RSI, relative strength index, relative vigor index, tricks, volume, William dot percentage R. If possible, read about them. So this is important. If you go for a job in any financial sector, stock market trading kind of job, if you do, you go, then you should have an idea about them. You should know what is technical analysis. Okay, I'll forward you this PDF on technical analysis. I'll forward you this PDF. So read about this PDF to know more about technical analysis. Okay. So going further about technical analysis, now let's discuss about fundamental analysis. So whenever you are analyzing, you can either analyze the stock, either fundamentally or you can analyze the stock either technically. So fundamental analysis is the method of measuring the security intrinsic value by examining the related economic and financial factors. The fundamental analysts study anything that can affect the security value from the macroeconomic factors such as the state of economy and industry conditions to the microeconomic factors like effectiveness of company management. So basically, when we talk about fundamental analysis, we just we just try to concentrate more on the fundamentals of the company. To like fundamentals of the company can be the business model of the company. Fundamentals can be of the company can be the management of the company. Fundamentals of the company can be the past performance of the company, which we can represent about a company in the term of balance sheet or profit and loss statement or cash flow or fund flow statement. So where by using them, we try to determine the value of the share of the company when we see the stock of a company. So by looking at the ratio, like either price to earning ratio, price to book value ratio, or price to sales ratio, or return on capital employed ratio, we compare the ratio of a particular company with respect to the industry ratio or the sector ratio of that particular sector where the company belongs to. And with that, we try to analyze that is this company is overvalued or undervalued in that context. And then the end goal here is to arrive at a number so through which we can compare the current price of the share with respect to the it intrinsic value to analyze the stock is either undervalued or overvalued. So if the stock is undervalued, then definitely as an investor we'll try to buy that share. So fundamental analysis is all about determining the stock real or fair market value, where we try to understand like what can be the possibly the development in the particular company with respect to its business model, how we can see the growth of that company with respect to that business model. All that we try to be more interested in the case of fundamental analysis whenever we try to analyze a company. So here in the case of fundamentals of a company, when we look into, so we need to understand possibly as an investor, so what value of the company can be interested. So any unexpected momentum in the value of the share can be the concern for us, because instead of simply looking into the price and volume, what we should do in the case of technical analysis, in the case of fundamental analysis, we see overall the qualitative and the quantitative aspect of the company. So qualitative aspect can be something which cannot be represented in the term of numbers, while quantitative fundamentals are simply numbers. And by numbers, either by looking at the revenue, profit, assets, we can analyze the companies which are more tangible in nature, while qualitative features of a company which are less tangible, which can be patents, proprietary rights of the company, or brand value, or to consider the brand equity of the company, or the brand positioning or brand recall of the company. We can understand the qualitative features of a company. So qualitative features can be the business model of the company, because altogether business model is very important. That shows what would be the life of the company. If the company belong to some kind of technological sector, then the company need to do lot of innovations. If the management of the company is not stressing on innovation, then definitely the life of company won't be big. So if that company belong to FMCG, or maybe in pharma sector, then we need to see the distribution channel of the company, the supply chain management followed by the company. So with that, we'll understand possibly the life of the company. or possibly how much that company can survive. By looking at the historical performance of the company, we can understand how innovative in the company. We can follow BCG metrics of or Porter's five model to understand where the company is lying with respect to the time frame they are working into the market. And management, again, management is altogether right from the beginning. I was telling you, for the fundamental analysis, we need to stress on the management of the company to understand the past performance of the management, the CXOs of the company, how aggressive they were in the past in the other companies where they're working. And by looking at the corporate governance of the company, how transparent or fair or efficient they are with respect to their published book of data to the shareholders of the company. So when we try to look into these aspects of qualitative nature, we need to see the financial statements of the company. Either it's a balance sheet or income statement or cash flow statement. So there we can analyze the intrinsic value of the share. So when we talk about intrinsic value of the share, there are different methods are there to calculate the intrinsic value of the share. We have discussed uh, two-stage growth rate model, three-stage growth rate model. We follow different models like constant dividend discount model. Okay, so with that, we try to determine the intrinsic value of the share by estimating the like future value of the share and then discounting the future value of share with the WECC and then finding the present value of the share. With that, we understand that what is the worth of that company in the real market. So that understanding already we have developed. So this numericals also like for exam purpose, we have done numericals also on two-stage and three-stage growth rate model. So like this kind of company, when you see Bharat Limited earning a dividend has been growing at the rate of 18% per annum, then this growth rate is expected to continue for 4 years. After that, the growth rate will be 12% for next 4 years. Thereafter, the growth rate will be 6% forever. So if the last dividend per share was 2 rupees per share and the investor required rate of return is 15%, what is the intrinsic value of the share? So we have done problems like this in the past to understand the 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 how to determine the intrinsic value of the share. So that is what we do in the case of fundamental analysis. So the objective of working on fundamental analysis is to determine the intrinsic value of the share. So when we are working on determination of intrinsic value of the share, when we are trying to understand the intrinsic value of the share, the possible objective of the fundamental analysis is to conduct a company stock valuation and to predict its price evolution, to make projections on its business performance, and to analyze its management and make internal vis- business decisions and to calculate its risk. So each share is assumed to have an economic worth based on its present and the future earning capacity, which we called at is its intrinsic value. So the purpose of fundamental analysis is to analyze the present and the future earning ability of the share based on its economy, industry, company fundamentals, and thereby to access the intrinsic value of the shares. Then the investor can compare the intrinsic value of the share with the prevailing market price to arrive at an investment decision. And if the market price is lesser than its intrinsic value, the investor should decide to buy the share as it is underpriced. So when we look into the intrinsic value, what is important for us that if the market price of the share is more than its intrinsic value, then it should be considered as a overpriced. And if we find that share to be overpriced, and if we have already bought the share, we should sell that share or we should put a stop loss on the share, possibly because we know that in the future the share can fall down. So fundamental analysis does provide an analytical framework for the rational investment decision making And this analytical framework is called EIC framework, or economy, industry, company analysis. EIC framework is important for your exam preparation. So, so EIC framework we'll discuss. Before that, you should basically understand. In the case of fundamental analysis, we talk about macro fundamental analysis, and we talk about micro fundamental analysis. So, macro fundamental analysis uh, possibly focus on broad economic factors that affect the stock price. So altogether, these macroeconomic factors are like inflation, or interest rate data, or government policies, or the world events which gonna impact the stocks directly or indirectly. In the case of micro fundamental analysis, we look into the micro factors like the management of the company, the union movement of the company, the supply chain management of the company, the decisions to give dividend or not to the shareholders, all that which going to impact to the company. Now, EIC framework is important when we are trying to understand the fundamental analysis. So, fundamental analysis insists that no one should purchase or sell the share on the basis of tips and rumors. The fundamental approach calls upon the investor to make the buy or sell decision on basis of detailed analysis of the information about the company, the industry to which the company belongs, and the economy. This result in an informed investing. So for this, the fundamental list, they make the use of EIC framework. EIC stand for Economy, Industry, Company Analysis Framework. So it is a news which affect the price of the stock in the market. So the news can be either company specific news, the news can be sector specific news, the news can be market specific news. So whenever any news about a company comes, so simply we should not run behind the rumors or the outcomes from that news. We need to understand how that news is going to impact the company or the industry or the economy, so which we called as a EIC framework. So this is what EIC framework is all about. So where when we work on fundamental analysis, we see both micro and macro factors into consideration. So where this in the case of EIC framework, this EIC framework is a three-layer analysis framework. In the analysis of the economy, industry, and the company is carried out. The logic behind the three layer is that the of the company depends on the performance of the industry and the economy as a whole. So in this era of globalization, we can add one more layer, which talks about international economy. So you know that international economy is very important parameter right now. This international geopolitical segment, like the recent presidential election where Joe Biden became the 46th president of USA. Now, before that, Donald Trump was there. So Donald Trump and China, they were fighting. So for the economic policies, now when the Joe Biden will come, the economic policies will altogether will change. Maybe Joe Biden will give give some status to Iran to allow them to open to trade independently. That way, India will start buying more oil from Iran. So automatically, the price of oil in India will decrease. So if the price of oil in India will decrease, automatically it will impact lot of segments of our industry directly or indirectly. So something which is happening in USA is directly or indirectly is affecting us. So in EIC framework, we talk about these kinds of factors which altogether which is going to impact the economy, the industry, and the company. So here you can talk about macroeconomic factors like growth rate of GDP, industrial growth rate, inflation, interest rate, industry related factors like demand and supply conditions in the industry, existence of substitutes, government policies. We can talk about company related factors like financial performance, operating efficiency, capital structure, competitive edge of the company. So altogether, when we discuss the fundamental analysis, it is more or less, it is very structured and formal approach to research on a stock value and its potential growth. So this analytical procedure facilitate the identification of overvalued and undervalued stock, which where we relate that where we the given data with the company earning potential, dividend income potential, and then we use them to analyze the asset of the company. And in doing that, when we are trying to analyze the asset of the company, we try to look into the potential impact of that asset creation with respect to the economic and the industry environment on that company is working on. So this is the basic understanding of the fundamental analyst of the company. So talking about this numerical, which is important for us in the case of fundamental analysis, this is based on three-stage growth rate model. Already we have done enough numerical in the past like this. So 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 here, when we talk about this numerical, here when we're talking about this, so here it is written, there's a company called Bharat Limited earning, its earning and dividend have been growing at the rate of 18% per annum. So this growth rate will continue for 4 years. So 18% annum, 18% per annum, that will grow for 4 years. That will grow for 4 years. Okay, then after that, the growth rate will be 12% for next 4 years. The growth rate will be 12% for the next 4 years. Okay, and then thereafter, the growth rate will be 6% forever. So then it will have 6% per annum constant growth rate. Then it will have 6% per annum constant growth rate. Last dividend was 2 rupees per share. Last dividend last dividend was 2 rupees per share. Last dividend to an industry in the investor required rate of return. Cost of equity is 15%. Cost of equity is 15%. So what is the intrinsic value of the share? So what is the intrinsic value of the share? So here what you can do, you can write year 1, 2, 3, 4. For the 4 year, it will grow. For the 4 year, it will grow at the growth rate. For the 4 year, it will grow at the growth rate of 18%. Okay. Then for the next 5 year, next 4 year, it will grow at 12% per annum. And then from ninth year, it is following constant growth rate model. So then from the ninth year, it is following constant growth rate model. So this question came for 6 marks. So this is not a 6 mark question. It's very lengthy. If we do in notebook, then it will be very lengthy. I'm doing in Excel, so I'll get the answer fast. But in exam, we can't do in Excel. So, so we have done enough numericals like this on fundamental analysis, which is basically this is basically the problem on three-stage growth rate model. This is basically three-stage growth rate model. So three-stage growth rate model numerical. We have done a lot of numericals based on three-stage growth rate models. So here the last dividend of the company was 2 rupees. So the last dividend for the company was 2 rupees. So if we talk about year zero, so the dividend that was 2 rupees. Last dividend for the company was 2 rupees. Now grow at the rate of 18%. Now it will grow at the rate of 18%. Now it will grow at the 18%. So year on year basis, we can find this value. Year on year basis, we can find this value. So I hope you are understanding this part. Then so if you want 60-year value, so 60-year value directly from here, then this would be 2 into, this has grown at the rate of 18% for how many years? For how many years? 4 years. Okay. So and then it is grow at the rate of 12%. So if this is 6th year, so which year is this? Second year for that. So once you get this value, then cost of equity. So cost of equity is 15%. So cost of equity is 15%. So once you find the cost of equity, you can find the present value of cash flow. You can find the present value. You can find the present value of the cash flow. So you can find the present value of this cash flow. This is the first year future value divided by 1 plus 15% to the power 1. Find the present value of cash flow. Do it till 8 years. Do it till 8 years, because from first year to 8 years you have super growth rate. If you see from first year to 8 years, you have super normal growth rate. So this from first year to this these values, this is the data. This data what you see, this is the data of super normal growth rate data. So this is the data of super normal growth rate. So and from ninth year you have constant growth rate. So from ninth year you have the constant growth rate. For the first 8 years, we have super normal growth rate. You can see. So 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 from first year to eighth year. So the company shows super normal growth rate. Normal super normal growth rate. So where the values of supernormal growth rate is 18% and 12%. So the present value of company during supernormal growth rate. During the supernormal growth rate. So if you want the present value, so this was the present value of the company. Okay, and then from ninth year it is following constant growth rate model. And from ninth year it is following constant growth rate model. So for the constant growth rate model, for the constant growth rate model, for the constant growth rate model, then for the constant growth rate model, we follow the formula called price of the share initial price of share is dividend, next year dividend minus KE minus G. This is the formula. So now from for here, this is starting from ninth year. So I'll find the price of the eighth year. The price of the eighth year is the dividend for the ninth year divided by KE minus the growth rate. So this is third growth rate, constant growth rate. That's why I wrote G3. Now, you know that P8 is equal to P naught into 1 plus cost of equity to the power 8. So now I can say that P naught is equal to P8 divided by 1 plus cost of equity to the power 8. So I can write P naught is equal to, in place of P8, I can write div9 divided by Ke minus G3 to 1 plus Ke to the power 8. This is all together. Just by this, we can find the present price of the share. So uh, here we can find the present price of the share. So we can find the present price of the share. So div9 divided by Ke minus G3, 1 plus Ke to the power 8. We can follow this formula. So this by with this we find the present price of the share. So div9 divided by, so when we see this, so here now, so if I see the present price of share under constant growth rate, under constant under constant growth rate. So the present price of share under constant growth rate, that is div9. So that is div9. That is div9. Div9 is this, divide by uh, uh, K minus G3. So K minus G3, K cost of equity 15% minus G3. G3, what is G3? 6%. K minus G3 into, and then 1 plus K to the power 8, 1 plus cost of equity 15% to the power 8, 8 to the power 8. So you got this is the price of share under constant growth rate. So hence the price of share you will get, and the price of share what you will get, that will be equal to this plus this. This is the present price of share. This plus this. This is 40.3316. So this is the present price of the share what you will get. So this is the numerical for the three-stage growth rate model numerical. Already we had done problem in the past based on this three-stage, two-stage, all the previous year numericals. Here we have done numericals on them. So this is just a kind of revision for you. So in fundamental analysis, we should have an idea based on this. So this share price what you get from the ninth year, we should determine the present price of this by using the constant growth rate model. So we followed the formula. So the for the constant growth rate model. So for the constant growth rate model, we followed the formula. Price of the share is equal to, the price of share is equal to the dividend at the end of ninth year divided by KE minus G3 into 1 plus KE to the power 8. This is the formula what we follow. Dividend for the ninth year divided by KE minus G3 divided by 1 plus KE to the power 8. Okay. Anyone, any doubt, any question you want to ask? So this is the final answer for this. So they ask us in this numerical, what is the intrinsic value of share? The intrinsic value of the share is 40.3316. This was not a 6 marks question. I don't know the logic of asking in 6 marks anyway. Anyone, any doubt?